Yeah, let's do something different today. We're going to talk cattle, but not until the end. And then we're going to fit in interest rates. And maybe we should start with the great corn debate that's going on. They're not so much on the soybeans, but the Twitter wars, the information, Facebook, call it whatever, online, everyone's debating the corn yield. So maybe we should start there. But, we plan on hitting a lot of topics today, and we'll see what happens.
I love that because I know you have some specific things you want to talk about cattle. I know you can't share 100%, but I know you'll share something at the end.
Yeah, we got cattle at the end here, so you're going to have to stick around and listen to us get through it all to get to the cattle. But I actually do have some ideas for hedges that we'll mention here at the end, or a brief little summary of what I'm looking at. But we'll cover a lot of ground today. I just don't want to talk about grains going down every day. I don't think anybody wants to hear that. So let's
start with what everyone doesn't want to hear.
Yeah, let's do a variety show today.
Welcome to Hedge Heads, where hosts John Prischman and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, it is a Monday. It's been raining and corn is in the red. So it seems like every other Monday this summer.
Yeah, at least the other grains weren't down. I mean, beans were up a little bit, and then wheat. We had great exports for soybeans and wheat. Corn inspections, I should say. It was good. Everything's been good. So we're moving it at a lower price. That's kind of how it works. So it's been...
You mean when things get cheaper, other people buy them?
They do, especially when there's this much carry in the market. It's on sale in front. Make sure you get it bought now. Otherwise, you pay 15, 16, 20 cents more. Beans have a massive amount of carry, and that's what a market's designed to do. If there's too much supply, get really cheap in front. Make it so you can't turn down that deal. And that's exactly what's happening. So we're at least seeing good exports. We're seeing good inspections. The problem we have is it appears that we're going to have a mega pile to deal with. And the funds are already short. They want to stay short. And we have zero catalyst to go higher. And that's kind of what we've been walking into every single Monday. You're looking for that weekend, something to change, and it just doesn't.
No, it doesn't. So let's talk some of the controversies. We got, let's start with the rumored FC Stone number of 190. What's the actual number and what are you trading?
Stone X now.
Stone X.
You just like Twitter and X. It's like it has it's easy to go off the old name, but
yeah,
I don't think it's out. The rumor was 190, and here's my thoughts on all this. Why does any of it matter at all? If anybody thinks that the price is going down because these private guys are putting something out, I mean, they're new to the market. It's brand new. Nobody cares what these guys say. These are all just guesses.
Hedge Heads says 176.
Yeah, exactly. Let's get the subs up. There's a lot on both sides. The problem you have with the online stuff, and I've talked about this in a lot of past podcasts, is that there's so much information being exchanged that you can basically generate any reality that you want to. Just follow all perma bulls, follow all perma bears. Now, the perma bull side, where they're more bullish on yield estimates or they're more bullish on the outlooks or demand, like they're going to get more followers naturally. Like it's become a business, and we'd even talked about this last time. And the problem you have you think with more information at your fingertips, you would be doing better than ever. Or more information at your fingertips, you'd have your pulse on all the politics, and it would all be perfectly good and great information. And exactly the opposite's happening in grains or politics or anything else. Like you just subscribe to what you want to hear. And it's always been that way, but now it's like easier than ever. So then if that doesn't work and your price doesn't go up, and it should be because you're subscribed to all the things that tell you that, then you get anger. And then the anger starts lashing out at random things like people putting out yield estimates. And do we know what the yield is this time of year? No, it doesn't matter. It really doesn't. We go through this kind of every year. I'd say some years are a lot more interesting than this year, where it is debatable. And there is like a region that's really under stress, or the Western Corn Belt's not doing good, or the Eastern Corn Belt, part of that's doing really bad, but hopefully the West makes up for it. We don't have any of that this year. So these people are just getting bored and fighting. And, it's probably not good to engage any of it. What you need to be doing is planning for December 26, November 26 beans, and start looking at ideas that are going to help you now. Because what if we're looking at a low here this time of year, and then you turn around and buy courage calls, it rallies like last year, and then you can make those sales, and you have your upside wide open. Instead of being negative, what I'm trying to say is be positive. There's so many of those fights out there, and you can find one every day. Today it's the yield fight, and
let me tell you, I have loved the inflation fights, though.
Yeah, that one's gone on forever.
That one is my favorite. I shared one on my Twitter. I think we chatted about it. It was the beauty of, 500 years ago, corn was at 2 cents a bushel.
Yeah.
So inflation is like 187,000, a bushel now.
And those arguments aren't that black and white. And it really, what you should think of corn is as a world price. Yes, you have a domestic price, and it's what the domestic people are willing to pay you. So the gripe should be with them, and then, of course, if they can't resell for a higher price, they're not going to buy it from a higher price, whether they're taking too much in the middle. That's really where the argument should be. But I still stand by, if you have the tools and the knowledge to actually combat that you're much better off, meaning know when to store it, know when to sell it, know when to roll carry, knowing whether you should store it at all or sell everything off the combine. And that's how you get better prices, being more knowledgeable about what you should do when and what tools you should use when. You don't do everything at a commodity brokerage like us. Like you do some things. You'll do a lot at the elevator. You'll use the elevator programs when that is to your advantage. What you want to get to when you're hedging, and this is what this is all about, is you want to get to an area where you play their game. Like you store it in optimal windows where you have a chance at more upside, better basis. The last 3 years, everybody just stores it and just let's store it in July and see what happens. Because historically, that's been actually a pretty good thing to do. That has failed miserably for the last 3 years. And we were gonna do a whole episode on storage, so we'll get a little bit into it. What I think guys are gonna have to do with storage is they spend a lot of money on it, and I'm gonna use it, and that's the attitude. I meant what how do you guys feel about their storage?
Well, I think that's exactly the attitude. If I spend a lot of money on something, I want to get my use out of it. Yep. And I don't want to sell it when it's under my cost. So I do want to store it. But
and that's where storage comes in.
If the price keeps coming down after I store it, that's not helpful either. Yeah,
where I think the storage goes off the rails is that if you put it in there, you're going to physically, there's a lot of work, there's logistics, there's time. You're not going to want to take it right back out. But I think that you're going to find that you're going to have to do that in certain markets. Last year, it went in the bin in fall. Everything it was really dry August and September, and then everything got harvested fairly quickly. Went in the bin, and I think that if a guy was more flexible with the attitude, this could go out in 3 weeks from now, or it might be all the way till June. If you go in with that attitude, you're going to do a lot better. Just mentally prepare yourself for the physical work and the logistics and the trucks and the help that you'll need if you need to get rid of it immediately, because the way these markets are moving, they will give you opportunity and then you have to take it. And I think a lot of guys turn it down out of that it's inconvenient. It's already in there. Let's see what happens with the weather in the spring and summer. And that attitude's been a complete disaster for 3 years.
Yes.
So I think a guy's going to have to modify and really get in the mindset that I'm putting this in there, but I might, if basis improves really quick and price improves really quick for whatever reason, I might have to take it out immediately. It's unlikely to happen, but I might have to start doing that.
Well, and that decision can be affected by so many factors. So if you're a farm that is running on an operating line or you have an operating note, you don't have nearly the flexibility that a farm who's not, or you have product that you can move and be, I don't want to, let's call it debt free, but you know what I mean?
Yep.
Where you don't, you're not reliant on paying someone back there. It's way easier to store that.
Yep.
Than if you're sitting on other notes or other loans that need to be paid or you need to buy inputs for next year or whatever. If you can afford to sit on it, that's a way different decision than, especially in today's, and we're going to get to that, but in today's interest rate environment, you got to be careful on that. So that has to be a factor in that storage too.
And like you say, they might not have the choice. The bank might have a more choice when you sell and then, or raising money for inputs and all that stuff. But in order to prevent this problem, so it's like it got to $4.90 last year, $5, and then you're thinking, should I sell it? Now, if you would have had bought a Courage call in the fall, not that we were recommending them, but had you had bought that, I'm sure there were probably 7-8 cents at the time, maybe $4.90, probably 6. I don't have a chart, but I can't think that March was more than 5-6 cents. Just like this year, you could buy a $4.90. March. What are they going for? Ryan will pull that up. I'm sure they're about 5-6 cents. So if you buy Courage calls this time of year, that will, I think, allow it to come out of storage a lot easier, meaning like you will retain ownership at $4.90, even though it's not physically there anymore. You still have it on paper. The problem that with people doing that is the price is low. The outlook is poor right now. And nobody wants to spend 5 or 6 cents just to throw it away. But these are just ideas to get out there for you guys to understand that this is how smarter hedging can begin. You're looking at, do I plan on sitting on this till next summer? Do I plan on selling on a rally? And do I want coverage if there's a rally? Or am I just going to wait and see what happens again and just play it day by day? I think that I do
want to jump in here real quick because I did pull up the $4.90. It is about 4.5 cents.
Okay.
Now, here's something that I don't have the March volatility number in front of me, but I saw
implied volatility is way low.
I saw December is like 16%. To give you an idea, it's usually when I see December, it's usually in the high 20s. Yeah, sometimes over 30.
And I tweeted out, you can see where it is in relation to the standard deviation and where it normally would belong. It's either +1 or -1, and it's below all that. It's below where it should be, meaning these options are incredibly cheap. So this would be a year that you would have that ownership of these calls. And this is something I'll be going over with my clients as we come into a seasonal bottom. Last year, I think there's been at least 3 bottoms in August in the last number of years, including last year, 2020 was another huge bottom in August, right after that bearish report. As a matter of fact, that's when they said 3 billion bushels. It bottomed on that day. So this is when you would, if that's the case, then this is when you would start looking at those calls. And I do have some calls sold for guys, and like we'll be looking, with the idea that if it looks like it's going to go higher, we're going to get out of those. Like these last round of calls that we sold are really on a short leash. Like, some of the 520s, 490s, or any that did in June, they're probably going to be fine, and they're getting down to where you can even get out and you have most of the premium. This last round of short calls, though, for March, it's starting to get dicey time of year to do that, and the premiums aren't there. So let's reverse it. What we were just talking about, start planning for marketing the crop that you're going to put in there, and then also December 26th. Is there anything I can do there? Right now there isn't, but that's something that you also should keep your eye on. Meaning, if we go to like a 60-cent carry, 70-cent carry between December 25 and 26, then you're starting to get into windows where it would make sense to maybe sell some calls on it, after a rally, stuff like that. But the point is it looks like there's nothing to do. And there's actually quite a bit of stuff to do. You have to start diving into your numbers and see what makes sense for you, whether you want to have these Courage calls going into next year. I would say 9 out of 10 times that you'll find a bottom at this time of year, and those will come in handy. There's other years where it goes down into December. Boy, if that's this year, what price would that be?
We're going back to the 80s.
Yeah. So we're gonna get a number on the 12th,
and I don't mean in dollars.
Yeah.
The year 1984.
Yeah, exactly. We're gonna have a number on August 12th, and we're gonna get a better idea of where the USDA is leaning. Like, meaning if they say 181.5, then all of a sudden maybe all these guys saying 190, 191 will breathe a sigh of relief and say, hey, it's not going to go up.
Are we comfortable as the hedge heads saying 176? Come on. I mean, we're pushing 176.
It depends. If more people subscribe when we say that, then yes, I'm very, no, just kidding. That's the game they play.
And the influence we have with the USDA.
I don't even think in those terms, and maybe I'm wrong. I think is this a number that we can take advantage of one way or the other? Would buying a strangle work? Would buying a straddle work? Would selling a strangle work? You know what I mean? I think more in those terms when I think of a USDA number. Now, it's a lot more personal to the farmer, but what are you going to do about it? This is a system we have. They're going to come out with their number, and then you have to react off it and make decisions off it. But it's still the first indication where we're headed with the yield, higher or lower. So it's going to be a big number. I mean, it could easily be 179 for all anybody knows and be a surprise 2 bushel lower, or it could be a shockingly bad one or good if you have that yield. But I mean, you could see a 191 for all anybody knows. I'm not 191. I mean, one like 183.
You want 191. I want 176. I just want to make that clear on the podcast.
I don't think that you're going to see anything out of the 2 bushel range on either side. I mean, you shouldn't, and they're going to be careful with all that. But then the October one will be scary, and the September one will be. But I think people get way too wrapped up in this, and they use this as a scapegoat to just be angry at like national numbers. What are you going to do? What can you do about it when the crop conditions were 73? So it didn't drop. It stayed. It's among the highest crop conditions. And yes, sometimes when the crop conditions go down, they don't lower yield. It doesn't mean that they're going to raise yield on higher crop conditions either. But still, you got to expect some bad numbers. The market's already fully got it. I think the main argument is that everybody thinks they're trading 185, 189 or something. I think they're not. I think they're trading at the most 182. You know,
that's pretty scary, actually. I mean, if it does come out in
it's hard to know what they're trading, but I don't know that I just think that they're on the right side. They have been since March. We talked about this. And they're simply riding the momentum because there's no buyers besides the physical buyers. And eventually that will bottom the market just like it did last year. So do we repeat what happened last year? Maybe, maybe not. Here's the bull part of beans is going to be the crush. The bear is going to be the poor, very poor exports. Corn has great exports already on the books. And the domestic side should be just fine. So the demand right now, that's the good news, looks good, except for really shaky on the soybean exports, really shaky. So far, that can change quick. So instead of engaging and just getting angry at all this stuff, it is what it is, and you're going to have to figure out a way how to deal with it and what's best, as far as storage, courage calls, the combination of everything. And that's really where all the concentration should be on, not what some private guy says or what even the USDA is going to say in August, because they're going to change it again in September. But there is a chance that is this mega crop out there, and they're going to measure it, and it is going to be, on paper at least, a very big crop, and we haven't seen the worst of what's going to happen in corn. And I think that's what people fear.
No, I agree. Let's shift gears here because I'm excited to announce that we do have a new sponsor in the fold, American Federal Bank. Love working with their ag bankers over there. We've had relationships with them for quite a while, and we're excited to bring them on as sponsors. So check out American Federal Bank. On that note, let's talk interest rates. I brought them up briefly when you were talking storage, but what are you seeing in interest rates out on the market there, John?
Rates have been coming down. You obviously had the Trump Powell stuff going on, and then the firing of the labor statistics woman. It's been a hot button topic. The argument is that if the numbers are bad, they should be out there, and then let's get interest rates lower to fix it. And the other argument is that inflation is not under control, and we need to even raise rates. You can make an argument for both. I mean, what you got is price wage inflation right now where wages go up. And then because you have to pay your workers more, the price goes up in the end product. So that's a bad spiral to be in. So it's very dangerous to lower rates too early. And, and I think that's what the argument is, that you want to make sure inflation's gone before you start doing that. And then Trump's argument would be that everybody else in the world's already lowering rates and you're way behind the eight ball, and then it's gonna fall apart before you realize that. And that's, you can debate that all day long with the brightest minds in the world that no one really knows.
You do have my opinion.
Yeah, you do have inflation still, without a doubt, and the readings are getting better, and then the jobs numbers didn't look great. So you get this back and forth argument. Long story short is the market rates, the bond prices are trending up right now, and the rates are going down. They're unlikely to move a lot anytime soon. We just had that Fed meeting there on last Friday, or was it Thursday? It doesn't really matter. But
last week, what was important from last week though was it's the first time in quite a while was not unanimous. There were two that voted two lower.
Yes.
So what that means for next month, we'll see. But as you talk about, they only control the 10-year, right? Or the front.
The front. Yep. There's only the short term is the only thing the Fed, unless they actively buy their own bonds like they did, in the big bailout in 2008.
Yeah.
So the front curve is the only thing that they control, and right now they're keeping it the same. And I don't think anybody's in a hurry out there to run out and lock this rate in because they think rates are going way higher. Everybody's definitely playing it day by day, hoping that they go down because that's what we're used to. Now, could they go higher? Absolutely, they could go higher. In this environment, though, really, unless you see the stock market, oil, and everything start to really rock and roll, I really don't think that they're going to raise rates anytime soon. I mean, what's your opinion?
Well, I can tell you, and another pitch for our sponsor, but I was in American Federal Bank the other day. I have a note that's coming up.
Yep.
And it needs to be renewed by January, and they said, we're not going to do it now. Let's wait till January. So that appears to be the feeling out there.
That's what I would do personally. The building that we're in here, that's not up for a little bit, but if it was, I would definitely be waiting as well, because things are calming down. You get a big Dow was down 600 the other day. Now it got all that back today, of course, because it only goes up and never goes down. But unless you see something that would indicate that inflation is going to just rip out of control, you wouldn't expect any rates to go up anytime soon. So lowers would be the bet. And I do like the short-term rates. It used to be euro dollars. That's U.S. rates in short-term. You can trade that here. But the SOFR futures is what they call them now, and I can't remember what the acronym stands for. But basically, it's short-term rates, and you can pick any time period that you want. You can lock in your own rates on per 100,000, and then have that locked in here. You don't have to have 100,000. That's the beauty. You just need the margin on that interest rate product. These are calls that
those options are super liquid also, and very reasonable to do the options too.
In the SOFR futures, everything is exceedingly liquid out many years. You can go 5-6 years every month. Or not every month, but you can go out essentially as long as you want and lock in rates. Of course, the market's not stupid. It's where they think the rate's supposed to be at that time.
And it's so liquid because there's so many guys trading. And when there's so many guys trading, there's also a lot of really brainy guys trading. That's not...
including all the major world banks and anybody at any huge trading houses. I mean, these are heavily traded contracts every day. As a matter of fact, they're the number one commodity in the world.
Yeah.
So you can
but they do trend. I mean,
yeah, so
tend to trend.
Once they get going in a direction, like we just had the meeting, they tend to trend until there's an event that makes you think one way or the other. So if you think that interest rates are going to go down, you can definitely do that here. Very easy, very liquid. You'd have to learn about it and understand how the contract works and everything, but it's a very easy thing to do. And so if you were thinking that rates are going lower, you would simply buy the SOFR futures, and then if they went up, then rates go down. They move inverse. So without getting too technical on all that, you can play the interest rate stuff here at any time. 30-year, 10-year, 5-year note, 2-year note. These are all the government notes. And then, of course, the SOFR futures, which is going to be U.S. Dollars on deposit. in shorter terms. So it's all there. All the tools are there. Those markets were gone forever because a decade we're at zero or longer than that.
It's hard to trade when all your rates are at 0%.
And I want to get it personally involved now, but it's been, well, you know what it's been like. You can't tell what it's going to do at all. And then you have a lot of politics involved, unfortunately, now.
And I don't have any money left in my trading account.
And then, you got to have a little bit in there.
Quarterly taxes kill. Let's not get into my trading account. But I
do really, really like them because, like you said, once the trend gets established, it tends to move that way. So they can be quite fun, and it's a thing. There's a lot of people that don't know that we even offer that. But once you get familiar with it, that'll be one of your favorite markets. And the reason is there's always news, there's always things that's moving it, and it's basically a pulse on the economy. It's really fun to keep track of. If you're into markets, it's one that you would keep your brain very active. You would start reading news that actually matters, what is actually going to move the markets. And it just is kind of this puzzle that is unsolvable and continuous, and everybody uses it at all times. It borrows money from the biggest companies to the biggest banks. So it's this super liquid thing that no one knows anything about. It's very mysterious. I shouldn't say no one. And they're intimidated by what if I guess wrong? It'd just be like you buying corn and getting out with a 3-cent loss. You can have stop losses, everything. Of course, you can have an event that can make it spike one way or the other. But generally, it's hard to make rates spike up fast. It's the rates, the idea that rates could go down fast, that can happen, but the up fast is a tougher one. So it's safer to go long than short. Well, I shouldn't say that. I mean, anything can happen.
There's nothing that's safer. But
it's still harder to make rates.
For compliance, we did not say that.
Yeah, back in the day when they used to move interest rates, I mean, they would raise it 2 points out of the blue and blow people up completely. We don't have that sort of politics anymore where the Fed guy used to do exactly what he was supposed to do.
You never know what will happen, though.
Yeah, you don't know, and they could raise it 2 points for all we know, and you just don't know. So never say never in those markets, but just be aware that is a very liquid market, and it's something people deal with all the time, and you're not locked into. You can be in any time frame that you want.
Let's jump into another liquid market because this one has been all over the board. Last week when we talked about energies, they were way up.
Yep.
And today they're back where they were a month ago. So
OPEC turned the spigots back on. So oil went down $1.50 today. And again, we're at that equilibrium price where all markets strive to be, but then the news changes and then of course it moves. But oil's done a really good job of settling in at a price where it seems to make everybody pretty happy. I don't know about the oil fields out west, how they're functioning at this price. I think they're right on the edge of profitability and not profitability. But it seems to be the balance, and there's not a lot of volatility there. Just very unlike the oil market. But today was a big day down, and we've settled into the 60s, and it really doesn't want to venture out of there at all.
I was just going to say, if I were a trader, I'd take a look at the charts and say, if it gets over a certain dollar, it appears they pump more oil. And if it gets down to a certain dollar,
and that 60,
that 60 to 70 range seems to be pretty. You could do some work around there.
And then why does OPEC open the spigots now? Well, I mean, they'll give you a reason why they're doing it. The idea is that they're going to run down the expansion for the U.S. production. They want to sell oil. They don't want us to sell oil, or they want us, to be able to buy oil from them and import. So it's in their interest to get a lower price during these time periods and hopefully run the production down to where later on they get a much higher price after U.S. is non-competitive and enough wells are out of business. And they've done this. This is the exact same cycle that we saw last time when Trump was in there or others, So they do it when it benefits them. Even though it looks like they're taking a pay cut, they are. It's just temporary. And then usually someone starts pumping more than they should, and then the whole thing, the distrust starts, and then they actually, then the whole OPEC thing gets in a fight. But anyway, they open the spigots again. They say they're going to pump a little more, and oil went down. And I don't think anybody's unhappy with that. And we had to do a seasonality where oil isn't generally climbing really sharply. So nice quiet market there.
quiet market.
Yeah.
It's a $2.30 range today.
Wow, that's nothing for oil. I mean,
That's true.
today was kind of a volatile day, but still for the range that it's been in, you look at that chart, that's unusual for oil to be this sideways.
Okay, when I was looking here, just to give you an idea, because we just talked liquidity.
Yes.
The front month oil contract has, let me make sure I'm reading this great because I don't have my reading glasses on, 338,000 plus in open interest.
Yeah.
The 10-year note has 4,971,000 open interest.
Yeah. See, I
You
don't.
talk about number of people trading in a market.
These markets are much larger than people realize, and it's a lot of institutional, and so you're not. It's Wall Street and the world's Wall Streets, wherever they are around the world. Yes, extremely liquid markets, very good spot to put money. And it's used every day by many, many people for a lot of different reasons. On the oil side of stuff, many of it are hedges from large oil companies for various reasons on both sides. It might, Southwest Airlines hedges their fuel. You're going to have specialized fuel markets where they hedge it. When you talk markets with like a kid that's interested or a teenager, or I've had some interns in here, they come in thinking the stock market's where all the action is, and that's the big markets. And when you look at the commodity markets versus the stock market and what's involved, the commodity markets absolutely dwarf all the stock stuff. I mean, it isn't comparable. Like you just mentioned a little bit, we haven't even talked about. Well, we talked about the short-term rates. Like all the contracts on a daily basis that are exchanged are mind-boggling, and we're used to grains and the beans, and a big volume day is, not that much compared to some of these other contracts. Huge markets, deeply liquid. It's great to learn about all of them. There's a lot of different ones, and they're used every day for hedging. I mean, that's exactly what the markets were designed for. And speculation, there's plenty of that, but you need people on the other side, so you need the speculators too. But yeah, they're just, it's fun. The guys that I have that trade, a lot of them they drive around, they listen, and they're interested in these stories that we talk about, and then they start coming back to commodities, and then, well, I'm familiar with this, and the way this moves, or a guy driving water around in the oil fields, I think oil is going to do this. Then they call us and they get involved in commodities. So it's not just farmers, it's definitely other guys that hedge these other products too. Dairy, non-fat milk, dry whey. I mean, there's people that are in thinner markets. So it's not just all corn, beans, wheat, and cattle. I mean, there's definitely a lot of other stuff going on. Hogs, I shouldn't leave out hogs.
Well, let's, on that note, let's wrap up with the other thing that seems to happen every Monday.
Yeah, this is
cattle is green.
Yes, this was a potpourri episode. It was all over the place. But hey, it's better than talking about grains going down every day. So the cattle got a different look here. We went down $6 on Thursday, right?
Yep.
And they're saying that's end of the month profit taking. Where are we on cattle, and what's it going to do? That is a question that comes up a lot. Now, it's not as common as it was because everybody just assumes this is going to go up every day, and people have kind of quit asking. But here's what you want to watch. Watch the box beef. Here's what's likely to happen. The Packers are going deep in the red. Nobody feels sorry for them, but still it's a business. They got to make money. Cash has been trending higher here lately. The box beef has been going down. You can't have that for much longer. So what they will start doing, and I think that it's probably started today, is they're going to cut the kills back, meaning they're going to kill less cattle. There's going to be less product. That should in turn make the product go up, the box beef. And so that will support their margins. Now, then what happens though is demand generally goes down on a higher box beef at these levels, which we've seen here recently. So that's where the trouble begins. They try to find that balance. If they can find the balance of killing the right amount of cattle, getting the box beef price right, you could sustain more of a cash rally. You can't keep having cash go up and box beef go down. So they're going to try to remedy that right now. That's the stage that we're in. You look at the seasonals, it says down. September is a really bad month coming up. Mid-August into September is really bad. and you're starting to see some cracks form in the cattle. Now, on Friday, I called a few guys. I was pretty excited. I actually have a few very good hedge ideas for cattle. You definitely have to call because it's very specific. It involves some of the deferred stuff and then some of the front stuff. If that makes sense to you. So you're using some of the premium in the back end to pay for some of the premium in the front end, but it's a little more complicated than that. Definitely give me a call. I finally have something that actually works for some of the stuff on the cattle side. I'm still using puts to use to keep the upside open at these levels. But you look at where August is, live cattle, 231. What do they call in cash? 235 to 240 in the south. They're going to go off the lower end. Let's call it 236. We're $5 under cash. I mean, that is not like the discounts that we're seeing. But you look at October.
Especially up at this level.
Yep. Especially at this level.
Yeah.
Also, I do have a butterfly that I'm looking at. Well, it's a modified butterfly, meaning it's got long cattle, short cattle, and then another short cattle, then a long cattle. So a bull spread and a bear spread in two different sets of months. And call me if you're interested in that. So I do have some stuff going on in cattle, and maybe I should have led with that. So it's getting a little more exciting, and it's getting, I wouldn't say predictable, but I think there's going to be a lot of volatile days ahead. And I think we're coming to a crossroads where the product is simply getting too expensive, and it's starting to come into the box beef price. And seasonally, that's what happens. I don't know. What are you seeing at the grocery store? I know nobody I talk to is happy.
I brought it up last week, and then I saw somebody just get ripped on Twitter over the exact same thing. But,
yeah.
I do think I love my steak, but $60+ for 3 ribeyes.
Yeah.
I mean, if it's just my wife and I that are going to have a steak, I'll pay $60 for 2 nice steaks, whatever, 3 nice. When we're feeding kids and it's just a family dinner, I'm sorry. I'm looking at chicken. I'm looking at something else. And, I definitely think producers deserve their money, but man, that's an expensive dinner.
Yeah. And that's what's happening, and it's going to happen. I mean, it's the final innings. Not that cash can't push significant. We could go parabolic and push to a high that's unsustainable. Like you don't know that, or it could be done here and cash could roll over, or cash could go up $5 more. We could rally $6 more and then be done. There's a lot of different combinations. Or is it the market that's different that went up and is always going to stay up? I wouldn't bet that way. There's never been a commodity that's done that. And I don't think cattle's first, but you never know. It could get tighter.
I mean, it could certainly sit in this range for a long time.
Very long time, yeah.
Yeah. I mean, you look at gold. Gold has sat in this range for a significant amount of time. It's been up and down, but
the biggest danger though for cattle, though, I think, is the speculators. It's been collecting people forever, and they aren't going to care box beef or whatever. I mean, pineapple. They don't.
Right.
When it doesn't look like they're going to make any money at this, what's been literally a money tree.
Yeah.
When it looks like it's done, they're going to get off the ride. Now, if there's no buyers on the way down, it could get really ugly. Meaning, we could get $30 discount to cash. Not that it should be, but it could get there. And then bounce out of there quite sharply. So there's a million different things that could happen. So I think that when the speculators finally leave, that it'll probably get very ugly for a period of time. We saw 189 not that long ago.
Right.
And very few speculators even moved out on that. So if they all went for the exit door, that would be quite a sight to see. But that doesn't mean it's going to stay down there. And that's why I prefer the puts over the livestock risk protection insurance. Because let's say you have a March put bought for feeder cattle, just for argument's sake, or January. It drops 30. Everybody $30 right away. Doesn't feel like it's going to stay down there. You can get out of the put where the LRP, you're stuck in your window that you bought. So I think it could be that market. But again, it's this bull that just doesn't quit, and one day it'll be over. I'm not cheering for that. That's just the natural function of the market. Many people will tell you why it can't go down. Markets tend to do what they're going to do, and it's probably starting to position for demand erosion here. And if they open the border in Mexico, it wouldn't take much of a catalyst to get a pretty good sell-off going here. You can feel the momentum drying up. But then, I say that, and it could be $5 higher cash tomorrow, and you could see, the stuff up $4, $5, $6, $7 easily tomorrow.
Absolutely.
Very volatile.
Well, John, we got to wrap up there. Why don't you leave your number in case people are interested?
Yeah, if they're interested in one of the 120 topics that we covered today in a lot of different varieties, they can call me at 218-731-1578.
Thanks, John.
Sure.